Are we too late for UK property, or is 2026 actually the start of the next big run? Interest rates are finally coming down, inflation is falling, mortgage deals are improving again, and at the same time, the housing shortage is getting worse, not better. Meanwhile, some of the biggest names in global finance, Blackstone, Legal & General, Aviva, are quietly buying thousands of UK homes. So in this video, I'm going to break down what's really happening, what the top analysts like Savills, Knight Frank and JLL are projecting for the next 5 years, and whether UK property still stacks up versus just putting your money into the stock market over the next decade. If you're new here, my name is Conran and I'm managing partner and founder at Mews. We help investors build long-term income and growth through UK and international property. And as always, this is education, not personal financial advice. Let's jump in. Number one, what actually happened in 2025? Now, firstly, let's talk about the year we've just had, because 2025 sets the scene for 2026. The UK housing market in 2025 was basically in pause mode. Prices ended the year almost flat. Halifax data shows house prices were up only about 0.3% year on year, with small monthly falls towards the end of the year. That weakness wasn't because demand disappeared. It was because interest rates were still relatively high for most of the year. There was uncertainty as well around the autumn budget and new taxes. A lot of buyers were just waiting for clarity before making a move. Towards the end of 2025, we started to see the turning point. The Bank of England cut the base rate to 3.75% in December, its sixth cut since August 2024. Inflation fell back to around 3.2% in November, down from double-digit levels just a few years ago. So we're entering 2026 with lower inflation and falling interest rates, but after a year where prices barely moved. That combination is interesting if you're thinking long-term. 2. Falling interest rates and better mortgages. Now, let's talk about interest rates and mortgages, because that's the big headline for 2026. As I mentioned, the Bank of England base rate is now 3.75%, which is down from around 5.25% at the peak in 2023 and 4% earlier in 2025. Markets are still expecting one or two more small cuts towards the end of the year, and we hope to hit the bank's target of 2%. So what does that mean in practice? In late 2023, a typical 5-year fixed buy-to-let mortgage was often 5 to 6% or even more for overseas buyers. By the end of 2025, the best 5-year fixes were coming in at around 3.75% for strong borrowers. Average 2 and 5-year fixed rates are still around the 4.5 to 5% mark, but trending down from the peaks. So mortgages today are meaningfully cheaper than they were at the peak, but we're not back to the ultra-low, almost free money era of 1 to 2% interest. And that's probably a good thing. It's more sustainable. So for investors, this means cash flow starts to look healthier again, especially in strong rental markets. When you fix your mortgage cost and rents keep rising, your real income improves over time. Number 3, housing undersupply. Why the shortage is getting worse. Now, cheaper money is only half the story. The other half is supply, and this is where the UK looks very compelling over the next decade. The UK government wants to deliver 300,000 new homes per year, but it keeps missing that target. Recent official data suggests England delivered around 196,500 net additional homes in the year to March 2025, well below that 300k ambition. At the same time, Savills note that build-to-rent completions actually fell in the year to mid-2025, and the pipeline of new rental homes under construction shrank by nearly 10%. Planning delays, higher construction costs, and political uncertainty were all slowing new supply. So while population and household formation continue to grow, new housing delivery is lagging, it's compounding. The imbalance is exactly what supports long-term price growth and persistent upward pressure on rents, especially in growing regional cities. This is why, even after a flat year like 2025, the medium-term forecasts for the big consultancies are still positive. Number 4. What are big institutions doing? One of the most telling signals for me is what the smart money is doing. Blackstone, the world's largest real estate investor, has been buying UK rental housing at scale. One recent deal with a house builder, Vistry, involved a £1.4 billion bulk purchase of around 4,500 homes, bringing Blackstone's UK residential portfolio to roughly 17,000 homes and continuing to grow. Through its Sage housing platform, Blackstone has committed more than £3.7 billion to deliver around 19,000 affordable homes, with thousands more in the pipeline. Legal & General has built a huge built-to-rent platform. Its institutional retirement business has committed £2.5 billion specifically into build-to-rent over the next 5 years, aiming to deliver thousands of new rental homes across the UK. Aviva Investors is doing something similar in the single-family rental space. For example, forward-funding new housing schemes like nearly 200 homes in Bedfordshire as part of a UK single housing investment. A Reuters piece summed it up nicely. Aviva, Legal & General and M&G are ramping up investments in the UK rental home market, betting on long-term returns in a market where demand far outstrips supply. So while some buy-to-let landlords are exiting under tax and regulatory pressure, global institutions are stepping in and scaling up. If these players with all their data and risk teams are committing billions of pounds, it tells you they see multi-decade structural demand for UK rental housing. 5-year forecasts. Savills versus Knight Frank versus JLL. Let's get into the numbers you asked for. The 5-year forecast, Savills 2026 to 2030. Savills' latest mainstream forecast, released in November 2025, expects average UK house prices to rise about 22% between 2025 and 2030, roughly £80,000 on the average home. They see modest growth in 2026, around 2% for that year alone, after halving their short-term forecast because 2025 was so subdued. But then stronger acceleration from 2027 onwards as rates fall further and confidence returns. Regionally, Savills expects the strongest growth in the more affordable northern and devolved regions. Northwest forecasting around 31% growth over 5 years, Scotland around 29%, Wales, Yorkshire and the Humber around 28%, the West Midlands 27 to 28%. The UK average around 24, but is all expected to outperform London, which is closer to 13 to 15% depending on the sub-region. So if you want a line for the video, Savills suggests that over the next 5 years, their strongest house price growth is likely to be in the northwest and wider northern regions, with cities like Leeds, Birmingham, Manchester being the beneficiaries, while London sees slower but still positive growth. On the rental side of things, Savills also point to major regional cities like Leeds and Birmingham, where rental growth is especially strong, supported by both affordability and economic performance. Knight Frank, their 5-year outlook was released in November 2024, and the forecast was a bit more conservative than Savills, but still positive. They expect average UK house prices to grow around 19 to 19.3% over 5 years, with annual growth of roughly 2.5% in 2025, 3% in 26, 3.5% in 27, and continuing thereafter. For rents, Knight Frank expects a cumulative 18.8% rise across the UK and around 17.1% in London over the same 5-year period, with particularly strong rental growth over 20% in prime central and prime outer London. Knight Frank sit just behind Savills with around 19% house price growth and 19% rental growth across the UK over the next 5 years, again with the strongest rental projections in undersupplied markets and parts of London. JLL's 5-year view is very similar in magnitude, but they're especially bullish on regional cities. The national forecast for 25 to 29 is roughly 20% house price growth and around 17 to 19% rental growth, driven by a chronic lack of supply and improving mortgage conditions. JLL's regional and city forecasts have Birmingham and Manchester at the top of the league table. One summary of their data highlights that Manchester is expected to see around 19.3% price growth to 2028, ahead of a national projection near 17 to 18%, with Birmingham ranked even higher. In some of their earlier 24 to 28 regional forecasts, cities like Bristol and Leeds are projected to see around 24 to 25% growth over that 5-year window, roughly 4.5 to 5% per year. JLL's 5-year forecast put Birmingham, Manchester, Leeds and Bristol among the strongest performers, with projected growth in the mid-teens to mid-20%, well ahead of the UK average. If you put all three together, the consensus from Savills, Knight Frank and JLL is UK-wide house price growth roughly between 18 to 22% over 5 years. Rents roughly 18 to 20% over 5 years, with the tightest markets doing more. Not spectacular boom time numbers, but very solid, especially once you add leverage. Number 6, why property is a long-term inflation-linked play. Now, forecasts are one thing. Let's zoom out and talk strategy. Property is fundamentally a long-term game. You're not buying for the next 6 to 12 months. You're buying for the next 10, 15, 20 years. 2 big reasons UK property continues to work in that time frame. Number one, it's a hedge against inflation. Especially with a mortgage, with a repayment or interest-only mortgage, your loan is fixed in nominal terms, say £200,000, but rents and property values tend to rise over time with inflation and with real wage growth. If inflation averages, say, 2 to 3% over the next decade, the real value of that £200,000 debt shrinks, while your rental income and property value grow in nominal terms. That's what people mean when they say property is a hedge against inflation, especially when you use sensible leverage. So even if you only get, for example, 20% capital growth over 5 years, if you're leveraged to 75% loan to value, your return on the cash you put in can be multiples of that before you even account for rental income. Number two, multiple exit options. Now, this is something that we don't talk about enough. Property has multiple exits. Hold long-term for rental income, you can refinance and pull some equity out after a few years of growth, or you can sell the asset outright, you have a tangible object. Or you look at the longer term, you pass assets on as a part of your estate planning. Compare that to owning a single stock where your only real exit is to sell the shares, often at whatever the market is doing on that day. So number 7, property versus the stock market over the next 10 years. So how does this compare to just putting your money into the markets? We obviously can't predict the future, but it's worth thinking about risk and behavior. Equities can deliver very strong returns, but they're also much more volatile. A 30 to 40% drawdown in global equities over a cycle is not unusual. Property markets, particularly in the UK, move more slowly. They can fall, we've seen that. But because they're less liquid and supported by that structural housing shortage, the moves tend to be shallower and slower. For many investors, a well-chosen UK property in a growth city, say Birmingham, Manchester or Leeds, with good rental demand, combined with a sensible finance and a 10-year hold period, can deliver a blend of capital growth plus 4 to 6% gross yields today with strong potential for higher real rental income over time. Stocks and funds absolutely have a place in a diversified portfolio, but if you want tangible collateral inflation, protection through rising rents, and the ability to use leverage to amplify returns, the UK residential property in 2026 still looks very much worth considering, especially if you focus on the undersupplied regional cities that the big players and the big forecasters are all pointing at. So, is it still worth investing into UK real estate in 2026? Based on falling interest rates, improving mortgage products, inflation coming down but still eroding the real value of long-term debt, a worsening housing undersupply across both for sale and the rental market, billions in capital from Blackstone, Legal & General, Aviva and others going into the UK rental and housing markets, consistent 5-year forecasts from Savills, Knight Frank and JLL pointing to high teens to low 20s% price growth and similar rental growth. My view, based on all of this, is yes, but it has to be done strategically with a long-term mindset. If you'd like to explore specific opportunities in the likes of Birmingham, Manchester, Leeds, or other high-growth UK markets, and you want help building a 10-year plan that fits you and your family's goals, then you can click in the link on the description and book a call with the team at Joseph Mews. If you found this useful, please hit the subscribe button and let me know in the comments which market you're most interested in, if there's any cities or any international markets. But thank you so much for watching, and I'll see you in the next one.